Hi everyone, and welcome to another lecture here in Module 2 where we're talking about investments. And in this specific lecture, I'd like to talk about debt investments again. And we introduced debt investments in a prior video, but now I'd like to talk about how we can calculate the selling price or the investment amount to be made in a debt investment, and a debt investment in the form of bonds. All right. So let's hop over to the computer now and let's take a look at a sample problem to understand this material. Okay, on your screen here on the left, I have an example problem, and on the right, I have a worksheet that I have set up for you to use to calculate a bond selling price or to create a loan amortization table. Okay, so let's start with the problem here on the left. On July 1st, 2024, Masterware Incorporated issued $700,000 of 12% bonds. So Masterware is borrowing money, and they're trying to borrow $700,000 in exchange for 12% interest to be paid to the lender. Okay, so that we have the face amount of the bonds is $700,000. The coupon rate is 12%. Now, interest on the bonds is paid semi-annually, so every 6 months. And the bonds mature in 3 years. United Intergroup here is the investor, so they are loaning the money to Masterware. They purchased the entire bond issue when the market rate for bonds of similar risk and maturity was 14%. Okay, so Masterware's bonds are paying 12% interest at a time when other bonds that look the same, have the same terms, same underlying risk, and at the same time that Masterware is selling their bonds, some other similar company is doing the same thing, but offering 14%. Okay, so why is this? Well, oftentimes what happens is a company will create the bond legal documents called the indenture, and in that set of documentation, there will be a stated interest rate, the coupon rate. Then there is some delay between when those legal documents are finalized and when these bonds are actually offered and sold in the open market. And because there is that slight delay, and because these bonds are bought and sold on secondary markets like the stock market, these are bond investments that can be bought and sold like stocks, the interest rate fluctuates in that period of time. So the bonds have legal documents that say 12%, but by the time Masterware gets ready to sell these things, the market rate of interest being offered went up to 14%. Okay, so what's Masterware to do here? If Masterware tries to sell these bonds in keep the same face value and keep the 12% coupon rate, then nobody's going to buy their bonds, because somebody could go and make a similar investment and get 14% interest instead of 12. So the only thing that Masterware can do here is reduce the value of their bonds, reduce the value from $700,000 to something less to compensate investors for that lower level of interest that they're going to be earning when they invest in Masterware, as opposed to investing in some other company. Okay, so there is a very specific way that we use to calculate the selling price of a bond. All right, now this spreadsheet is set up to do that for you. All right, so if you go over here to the spreadsheet, these bonds are being sold on July 1st, 2024, and the face amount of the bonds are $700,000, and the coupon rate is 12%, and these are paying interest semi-annually, and the time to maturity in years is 3. Okay. The market rate for similar bonds is 14%. Okay, and then this spreadsheet does everything for you. It calculated the selling price, and it calculated it created the bond amortization table. All right, but let's take a look at what it did. All right, so the selling price. Let's look at this piece first. So the selling price is based on two things. Now, Masterware is going to be paying coupon payments every 6 months for 3 years. So there's going to be 6 coupon payments based on 12% interest and $700,000 loan amount. And this $42,000 is that coupon payment. So they're going to pay 12% interest annually on $700,000 of a loan. So 12% times 700,000 divided by 2, because they're going to split their annual payments up into 2 pieces. That will give you the 42,000. All right, so that's the first piece here. So the bonds will pay $42,000 every 6 months for 3 years. That is an annuity. So this bond has an annuity feature. It has the coupon payments, which are an annuity. Okay. The second piece here is in 3 years, Masterware will repay the $700,000 borrowed, the principal. Okay. So we have the $42,000 series of payments, the ordinary annuity, and then we have the principal that's going to be received in 3 years. So this all leads us to time value of money. Because we have to wait for a period of 1 year or longer, we have to incorporate the time value of money into the valuation of our investment. And we have to value each of these things separately. So what is the value of the annuity of $42,000? Well, we're going to take the present value of an annuity of $1, and we're going to multiply our $42,000 times that discount factor. Now, you could pull this discount factor off of a time value of money table. You could calculate it here in the spreadsheet. And if you need additional help with that, I'd be happy to make a video, or I'd be happy to walk you through that in person. But that's what this factor is here. This is from the present value of an ordinary annuity of $1 table, where N, the number of periods, is 6, right? Remember, we have a 3-year bond that's paying interest every 6 months, so 2 payments per year times 3 years, that's 6. And we're going to discount this at 14%, which is the market rate. So we want to price these bonds so that they will yield the market rate of interest, not the coupon rate. We want to yield the market rate of interest to investors. Okay? So this is the discount factor, present value of an ordinary annuity of $1, where N is equal to 6 and the interest rate is equal to 7. Here, the principal, this is the present value of $1, where N is equal to 6 and the interest rate is equal to 7. Okay? We multiply these things across, and then we get our bond selling price. So this makes sense because Masterware is offering 12% when other companies are offering 14%. So Masterware has to lower their price from $700,000 to $666,634. All right. So last thing now is our loan amortization table, or our bond amortization table. Now this is a very useful table because it allows us to record all of our journal entries for the life of this bond, or this bond investment. Okay? So you'll notice across the columns here of date, cash interest, effective interest, amortization of the discount or the premium, the discount or premium balance, and then the amortized cost of the investment. So the amortized cost of the investment starts at that $666,634. This discount here is the difference between that number and the face amount, which is $700,000. Okay, so we offered a discount to United for $33,366 to compensate them for the lower coupon payment amount compared to the market. Okay, so that is where we are beginning. And then each period, Masterware is going to pay United, going to pay us, United, we're the investor, $42,000 of coupon payments. But GAAP requires United to record our interest revenue at the effective interest. So these bonds have been priced at 14% interest. That's where this number is coming from. We use 14% interest when we pulled in these discount factors. So our effective interest is actually, it's not this 12% that's being used to calculate the cash coupon payment. It's actually the 14%. So we're going to take, to get this number, we're going to take the previous balance, multiply that by 7%, or 14% divided by 2 periods. Okay? That's how we get this number. And then the difference between the cash interest being paid and then the effective interest, we call the amortization of the discount. All right? And another way that you could think about this is if you take the cash interest plus the amortization of the discount, that gives you your total effective interest. So what we are saying in effect is that our interest is being received in two forms. We're getting the cash piece, but then we're also saying part of the discount that we received up front is our compensation for that missing 2% of interest compared to the market. Okay, so those two things combined allow us to generate investment revenue equal to 14%. Okay, all right, and then because we're using some of that discount, the discount balance is going to go down, which results in our overall amortized cost of the investment to go up because now we have a lower discount. And you'll notice as you go across the years here, eventually the amortized cost of this investment grows to $700,000, which is the face amount. We have no more discount to amortize, and we've recorded all of our effective interest revenue that yielded to us 14% interest. All right. Well, I hope this video has been helpful. I think you probably should sit down, look at this spreadsheet, look at the calculations, look at the formulas, and see how things are being calculated in this, and practice some additional problems. Look at different problems, look at different interest rates. Look at cases where companies are investing at a premium and see what things look like. All right, well, and if you need additional help, please don't hesitate to reach out. I hope you found this video helpful. Thanks for watching. Take care.